The warning signs are flashing bright red, yet most people have no idea what's coming. What we're witnessing right now isn't just another housing correction. It's the buildup to a financial detonation that could hit global banking systems with the same ferocity that subprime mortgages did in 2008. But this time, the banks might not survive the impact. And if you're watching this, listen carefully. What's unfolding is far more dangerous because it isn't being driven by reckless lending to homeowners. It's being fueled by a collapse in commercial real estate, massive hidden bank exposure, and the rapid decline of property utility due to huge shifts in how we work and live. Over $2 trillion in commercial real estate debt is coming due by 2026. Much of that was borrowed when interest rates were near zero. Today, those loans are being refinanced at 5 to 8% interest, while the value of those same buildings has dropped by 30, 50, even 70% in some areas. Think about cities like San Francisco, Chicago, New York, and London. They're seeing office vacancy rates soar above 25%. Many of these iconic office towers are now worth less than half of what they owe on their mortgages. The banks have been delaying, hoping for a magical recovery. They're extending loans, pretending everything is fine, a strategy known as extend and pretend. But the recovery isn't coming. Remote work isn't a temporary trend, it's a permanent structural change. On top of that, AI and automation are reducing the need for corporate office space even further. Property owners are trapped. They can't afford to refinance their loans, and their tenants aren't coming back. This is creating a deep structural crisis that traditional economic models never saw coming. Now, here's what most people don't know, and it's the most critical part. It's not the big, too big to fail banks that are most exposed. It's the regional banks. They hold nearly 70% of all commercial real estate loans in the United States. These are the same small and mid-tier banks that we saw teetering on the edge of collapse back in 2023. They simply cannot absorb the massive losses that are coming once regulators force them to mark these properties to their true, much lower market value. And it's not just me saying this. Analysts from major firms like UBS and Moody's, even insiders at the Federal Reserve, have been quietly voicing serious concerns. They've warned that hundreds of these banks could fail if reality is forced onto their balance sheets. And it doesn't stop there. These banks are all deeply interconnected. They're linked through complex financial instruments like derivatives, interest rate hedges, and securitized debt. This intricate web means that when one bank starts to wobble, it can trigger a domino effect, exposing the entire financial system to a catastrophic chain reaction. The smart money is already making its move. Big institutional investors are quietly exiting commercial property, selling off their holdings before the panic starts. At the same time, private equity firms are raising massive funds, getting ready to swoop in and buy these distressed buildings for pennies on the dollar during a fire sale. They know what's coming, and they're positioning themselves to profit from the chaos. And if you think this won't affect you, the average person, think again. When these banks start collapsing, credit availability for everyone will evaporate. Getting a loan for a car, a small business, or even a home will become incredibly difficult and expensive. Businesses that rely on credit lines to operate will fail, leading to rising unemployment. And as liquidity tightens across the entire system, residential housing prices will inevitably fall. What's coming isn't just another downturn, it's a credit collapse sparked by a crisis in real estate that will ripple through every part of our economy. This is why, if you're watching this, you need to hit that subscribe button right now. Because the information I'm about to share could be crucial in helping you protect yourself, your business, and your investments before this crisis becomes front-page news. I want to hear from you. Drop your thoughts in the comments below. Do you think the banks will be bailed out again? Or is 2026 the year the system finally resets itself? Stay with me until the very end, because in the next part of this video, I'm going to reveal exactly how this crisis will unfold, step by step. And more importantly, I'll show you what the world's biggest investors are secretly doing right now to prepare. You won't want to miss this. So how exactly does this commercial real estate crisis trigger a banking failure? Let's break it down in a way that's crystal clear. We're talking about a storm that's been brewing silently, and it's much bigger than most people realize. To understand the danger, you first need to understand how commercial real estate works. Unlike your home, these massive office towers and shopping centers are businesses. They operate on long-term leases, which create a predictable, structured cash flow for the owners. Think of it like a subscription service. Tenants pay rent every month, and that money pays for the building's mortgage, taxes, insurance, and hopefully leaves a profit. For decades, this model was considered rock solid. But what happens when the subscribers, the tenants, start canceling? That's exactly what's happening right now. When a major tenant leaves, that shiny glass tower stops being an asset and instantly becomes a massive liability. All across the country, entire floors of what used to be premium grade A office space are sitting dark. They are generating zero income. But the owners' bills don't stop. They still have to pay property taxes, hefty insurance premiums, and most importantly, the massive debt obligations they owe to the banks. This is where the first crack in the system appears. The cash flow has dried up, but the expenses are still flowing out like a torrent. Now here's where the problem explodes. Most commercial real estate loans aren't like your 30-year home mortgage. They are shorter term, typically 5, 7, or 10 years, which means they constantly need to be refinanced. And when it's time to refinance, the bank needs a new, updated appraisal of the property's value. This is the ticking time bomb. Valuations for these office buildings are collapsing at a speed we've never seen before. A building that was proudly valued at, say, $100 million back in 2019 might now get an appraisal for just $45 million. That's a more than 50% drop. But here's the killer detail. The mortgage on that building could still be $70 million. Suddenly, there's a $25 million gap between what the building is worth and what is owed on it. This is called being underwater, and that $25 million gap translates directly into a loss for the lender, the bank. The bank is now holding a loan that is significantly larger than the value of the asset securing it. Now, multiply this single scenario by thousands upon thousands of properties all across the nation, and you're not talking about millions in losses anymore. You're talking about trillions of dollars in potential write-downs for the banking sector. It's a black hole of debt that threatens to swallow balance sheets whole. In a normal market correction, you'd expect other players to step in. Traditionally, real estate investment trusts, or REITs, and big institutional investors like pension funds would see this as a buying opportunity. They'd swoop in, buy distressed properties at a discount, and stabilize the market. But this time is different. Even these big players are retreating. They're sitting on the sidelines holding their cash. And you have to ask yourself, why? Why aren't the so-called smart money investors jumping in? The answer is terrifyingly simple. The entire lending system is frozen solid. Banks are caught in a deadly trap. They cannot issue new loans to potential buyers while their books are already overflowing with these toxic, devalued commercial real estate assets. This creates a classic liquidity trap. There's no cash flow from the buildings to pay the old loans. There's no refinancing available to extend them. And there are no new buyers because they can't get loans either. The entire market grinds to a halt. It's a domino effect in slow motion, and we're just starting to see the first pieces wobble. But what caused this massive exodus from office buildings in the first place? It's easy to blame remote work, but the story is more complex and, frankly, more permanent. Many major corporations are making a fundamental shift to hybrid or even fully remote structures. And listen closely, this isn't just because their employees are demanding it. It's because artificial intelligence and automation are allowing for incredibly cost-efficient, decentralized workflows. Think about it. When AI can handle vast amounts of back-office work, data processing, and even customer service, companies simply don't need the same number of people sitting in expensive cubicles. They no longer need the same physical capacity. And it gets worse for the building owners. On top of losing tenants, you have to add in the soaring costs of maintenance, security, and especially energy for these older, less efficient office structures. Many of these buildings are becoming economically unviable. It costs more to keep the lights on in an empty building than what it could possibly generate in rent, even if they found a tenant. It's a perfect storm of declining demand and rising operational costs, pushing these properties toward inevitable default. Now let's connect this back to your money and the stability of the entire financial system. If banks start to face large-scale insolvency because of these commercial real estate losses, who's going to back them up? We all rely on the FDIC, the Federal Deposit Insurance Corporation, to protect our deposits. But the FDIC Insurance Fund is designed to handle a few isolated bank failures. It is absolutely not equipped to handle hundreds of simultaneous failures, especially if some of them are major regional or even national banks. The fund would be wiped out in an instant. So what happens then? The government, the Federal Reserve, would be forced to step in. But look at the current situation. We have skyrocketing fiscal deficits and intense political instability. Another round of massive TARP-style bailouts like we saw in 2008 would be incredibly difficult to pass. And even if they did, printing trillions of new dollars to save the banks could trigger runaway inflationary pressures, destroying the value of the dollar and punishing everyday citizens. Some analysts are already whispering that this crisis could force a major, radical shift in monetary policy. We're talking about possibilities like controlled devaluation of the currency or a complete regulatory restructuring of the banking sector itself. Nothing would be off the table. While the average person is distracted, the biggest players in finance are getting ready. Hedge funds like Blackstone and Apollo are reportedly preparing billions and billions of dollars in dry powder. This is cash they've set aside specifically to scoop up these distressed properties at 70, 80, or even 90% discounts. They are anticipating a forced liquidation scenario where banks will have no choice but to sell these assets for pennies on the dollar just to get them off their books. Their timeline? They're looking at a window between 2025 and early 2027. This isn't some wild conspiracy theory. This aligns perfectly with recent forecasts from institutions like Deutsche Bank, which warned that the stress from commercial property could last even longer and be more painful than the residential housing crisis after 2008. And here's the scariest part. Most average investors, most everyday people, won't see the full impact of this until it's far too late. The hit will become obvious only when loan defaults start appearing in public records and smaller regional banks begin to fail, one by one. By then, the damage will have been done. That's why if you're still watching this video, you are already ahead of the curve. The smartest move you can make right now is not to panic, but to prepare. It's about understanding which banks are overexposed to this specific type of debt. It's about repositioning your liquidity, your cash, into safer institutions. It's about keeping your own credit lines available and, most importantly, staying informed from sources that aren't just repeating the mainstream headlines. Here on this channel, we are dedicated to revealing exactly what the mainstream media brushes off until it's front-page news and everyone is in crisis mode. We give you the information before it's too late. So, if you found this valuable, I urge you to subscribe now and hit that notification bell. Our very next video is going to be a crucial one. We'll cover practical steps on how to prepare your finances for this storm, what sectors of the economy could collapse alongside real estate, and which specific assets might actually rise in value during this period of chaos. Before you go, I want to hear from you. Drop a comment below with your thoughts. Do you believe the Fed will step aside and allow the free market to correct itself? even if it means widespread pain and bank failures? Or will we witness another massive wave of public bailouts, protecting the institutions, but leaving the citizens to deal with the consequences? Let us know what you think. Stay tuned and stay safe. What's coming is going to redefine the financial landscape for a generation. Thanks for watching.